14 questions 50% CFA Level 1 candidates failed to grasp, including 2 crucial ones at the end. Acquisition of intangible assets. Question 14. An analyst is reviewing Cyber Solutions Incorporated, a software company. In the current year, the company incurred €5 million in costs related to the internal development of a new product. The company's management decided to expense these costs as incurred, determining they did not meet the criteria for capitalization under IFRS. What is the most likely impact of this decision, compared to a decision to capitalize the costs? A lower current year return on assets. B. Higher current year total asset turnover. C. Lower future year profit growth. Correct answer, B. Expensing the €5 million development cost is charged immediately to the income statement. This reduces net income but does not create any asset on the balance sheet. Total assets are lower because no intangible asset is recognized. Since total asset turnover equals revenue divided by average total assets, expensing reduces total assets directly, while revenue remains constant. This always increases the asset turnover ratio in the current year. A. Incorrect. ROA equals net income divided by average total assets. Expensing decreases both net income, numerator, and total assets, denominator. The net effect on ROA is uncertain because these changes move in opposite directions. In many cases, the drop in assets is proportionally larger than the drop in income, which can actually increase ROA. C. Incorrect. Expensing the full €5 million is recognized now, reducing current year profit but eliminating future amortization expense. Capitalizing the cost would be amortized over future periods, lowering future profits each year. After the current year, future profits will be higher, not lower, because there are no remaining amortization charges. Question 13. 2 software companies, Kappa and Lambda, each spend $2 million in the current year on developing new software for internal use. Kappa's costs meet the criteria for capitalization under IFRS, so it capitalizes and will amortize the cost over 4 years. Lambda's costs do not meet the criteria, so it expenses them entirely. Which of the following statements is most accurate for the current year? A. Kappa will report a lower cash flow from operations. B. Lambda will report a higher return on assets. C. Kappa will report a higher net profit margin. Correct answer, C. Kappa capitalizes the $2 million development cost and recognizes only $500,000 as amortization expense in the current year, $2 million divided by 4 years. Lambda expenses the entire $2 million immediately. With identical revenues, Kappa's lower expense, $500,000 versus $2 million, results in higher net income. Net profit margin, net income divided by revenue, is therefore higher for Kappa. The $1.5 million difference in expenses directly translates to a higher profit margin for Kappa. Capitalization versus expensing affects both the income statement, timing of expenses, and balance sheet, recognition of assets. Net profit margin comparison is straightforward when revenues are equal, as the expense difference directly impacts net income. Cash flow classification differs. Capitalization shifts cash outflows to investing activities, while expensing keeps them in operating activities. ROA comparisons require analyzing both net income and asset-based changes, as they move in the same direction, higher for Kappa, but by different magnitudes. The most certain financial statement impact in this scenario is the effect on net profit margin, as the expense recognition difference has a direct and predictable effect on net income relative to revenue. Question 12. 2 tech startups, Zeta and Theta, are identical. This year, both spent $800,000 on developing software for sale. Zeta capitalized $600,000 of these costs after technological feasibility was established, while Theta expensed all $800,000. Ignoring taxes, which of the following is most accurate for the current year? As Zeta will report a higher fixed asset turnover. B Zeta will report a higher return on assets. C Zeta will report a lower cash flow from operations. Correct answer, B. ROA formula. ROA equals net income divided by average total assets. Zeta situation. Capitalizes $600,000 of development costs, recorded as an intangible asset. Expenses only $200,000 in the current year. Net income is higher by $600,000 compared to Theta, which expenses the full $800,000. Total assets are higher by $600,000 due to the capitalized cost. Theta situation. Expenses all $800,000 immediately. Net income is lower by $600,000 compared to Zeta. Total assets remain unchanged, no capitalization. The $600,000 increase in net income outweighs the $600,000 increase in assets. The ratio improves because the numerator, net income, increases proportionally more than the denominator, assets. Zeta's ROA is significantly higher. Capitalization defers expense recognition to future periods through amortization. Expensing recognizes the full cost immediately, reducing current net income. On income statement, capitalization reduces current expenses, increasing net income. On balance sheet, capitalization increases assets, intangible assets. On cash flow statement, capitalization moves cash outflows from operating to investing activities. ROA improves when net income increases proportionally more than assets. Fixed asset turnover decreases when assets increase without a corresponding revenue increase. CFO increases when expenses are capitalized, removed from operating section. If you think this is helpful, like this video and subscribe this channel. Question 11. A company reporting under IFRS holds the following assets. For which asset is the company required to perform an annual impairment test, but is not permitted to recognize amortization expense? A brand name with a legal life of 20 years. B. A broadcasting license that is perpetual and expected to be renewed. C. A patent with 15 years remaining until its legal expiration. Correct answer, B. This asset is classified as having an indefinite useful life because it is perpetual and expected to be renewed indefinitely. There is no foreseeable limit to the period over which it will generate net cash inflows. According to IAS 38, intangible assets with indefinite useful lives are not amortized because there is no systematic allocation of their cost over time. These assets must be tested for impairment annually, regardless of whether there are indicators of impairment, to ensure their carrying amount does not exceed their recoverable amount. A. Incorrect. The brand name has a legal life of 20 years, which typically establishes a finite useful life unless there is evidence to the contrary, e.g., indefinite renewal without significant cost. Finite-lived intangible assets must be amortized over their useful life, which in this case would be up to 20 years. Impairment testing is only required when there are indicators that the asset may be impaired, not annually. C. Incorrect. The patent has a definite remaining legal life of 15 years, establishing a finite useful life. Finite-lived intangible assets, like patents, must be amortized over their remaining legal life or useful life, whichever is shorter. Similar to other finite-lived intangible assets, impairment testing is only required when there are indicators of impairment, not annually. Indefinite-lived assets are not amortized and require annual impairment testing, while finite-lived assets are amortized and tested for impairment only when indicators exist. IAS 38 provides specific guidance on the recognition, measurement, and impairment of intangible assets. Understanding these requirements is essential for correctly classifying and accounting for intangible assets. Impairment testing ensures that the carrying amount of an asset does not exceed its recoverable amount. Indefinite-lived intangible assets require more frequent testing, annually due to their lack of amortization and the uncertainty surrounding their useful lives. Question 10. A company reporting under IFRS has two major intangible assets. a finite-lived trademark, and an indefinite-lived brand name. All else equal, compared to the indefinite-lived brand name, the finite-lived trademark will result in higher annual expenses in the early years of its life, be a lower net book value on the balance sheet over time, see a higher frequency of required impairment testing. Correct answer, B. The essential distinction under IFRS, IS 38, lies in amortization versus impairment testing for intangible assets with finite and indefinite useful lives. A finite-lived trademark is amortized systematically over its useful life. Amortization expense reduces the carrying amount of the asset each period, lowering its net book value on the balance sheet. An indefinite-lived brand name is not amortized because there is no foreseeable limit to the period over which it is expected to generate benefits. Its carrying amount remains constant unless it becomes impaired. Therefore, over time, the finite-lived trademark will have a lower net book value than the indefinite-lived brand name, assuming no impairments occur. A. Incorrect. Finite-lived intangibles are usually amortized on a straight-line basis, leading to equal annual amortization expenses. The statement about higher expenses in early years suggests an accelerated method, which is uncommon for intangible assets unless the consumption pattern justifies it. The indefinite-lived brand name has no amortization expense, only impairment charges if necessary, so this comparison is misleading. Be incorrect. Finite-lived assets are tested for impairment only when indicators exist, event-driven testing. Indefinite-lived assets are required to undergo annual impairment testing under IS 36. Hence, the indefinite-lived brand name, not the finite-lived trademark, has a higher frequency of required impairment testing. Finite-lived intangible, amortized each year, carrying amount declines steadily. Indefinite-lived intangible, not amortized, tested annually for impairment, carrying amount remains stable unless impaired. Question 9. A company acquires a customer list from a competitor for a cash payment, compared to if the company had spent an equivalent amount to internally develop a similar customer list. This external purchase will most likely result in the year of acquisition, higher net income, B. Lower total assets, C. Lower cash flow from operating activities. Correct answer, A. Purchased intangible assets, customer list, are capitalized on the balance sheet. Only amortization expense, fraction of total cost, hits the income statement in year 1. Internally developed costs must be expensed immediately under IFRS or US GAAP. External purchase results in significantly lower year 1 expenses. Example, $1 million purchase versus $1 million internal development. Purchase, $200,000 amortization expense, assuming 5-year life. Internal $1 million expense immediately. Net income difference $800,000 higher for external purchase. Be incorrect. External purchase creates an intangible asset on the balance sheet. Internal development produces no recognized asset, cost expensed. External scenario increases total assets by the capitalized amount. Example, $1 million purchase creates $800,000 net asset after year 1 amortization. Internal scenario reduces cash by $1 million with no asset recognition. Total assets are higher, not lower, with external purchase. See incorrect. Cash outflow classification differs between scenarios. Purchase, investing activities cash outflow. Internal, operating activities cash outflow. External purchase actually increases operating cash flow. Amortization is non-cash, added back in indirect method. Internal development shows full $1 million cash outflow in CFO. Net effect. External purchase results in higher CFO. Example, $1 million purchase shows 0 in CFO versus $1 million reduction for internal. Capitalization versus expensing. Purchased assets are capitalized and amortized. Internally developed assets are generally expensed. Balance sheet, higher assets from capitalization. Income statement, lower expenses from amortization. Cash flow: different classification of outflows. Revenue generation timing. External purchase allows immediate revenue generation. Internal development may delay revenue realization. IFRS GAAP requirements. IAS 38 prohibits capitalization of internally generated customer lists. US GAAP has similar restrictions for most internally developed intangibles. Question 8. Under US GAAP, which of the following intangible assets, acquired in a business combination, would most likely be recognized separately from goodwill? Highly skilled and assembled workforce. Be a non-contractual customer relationship that is separable from the business. See the inherent value of a company's market leadership position. Correct answer, B. Meets the separability criterion under US GAAP. Even without a formal contract, if the customer relationship can be sold, transferred, licensed, or exchanged independently of the business, it must be recognized separately. Example, a customer list or database that could be sold to a competitor. Recognized as an identifiable intangible asset and amortized over its useful life. The ability to separate the asset from the business is what matters, not whether there's a contract. A. Incorrect. Explicitly excluded from separate recognition under ASC 800-520 to 55-6. Cannot be separated from the business, you can't sell employees as a group. Doesn't arise from contractual or legal rights, employment is typically at will. Value is subsumed into goodwill, rather than recognized separately. Workforce value is part of the synergies captured in goodwill. See incorrect. Represents competitive advantage and brand reputation in a general sense. Not separable, cannot be sold or transferred independently. Doesn't arise from contractual or legal rights. Too nebulous and intertwined with overall business operations. Value is captured in goodwill, rather than recognized separately. 2 criteria for separate recognition. Contractual or legal rights or separability. Separability means the asset can be sold, transferred, licensed, rented, or exchanged independently. Goodwill captures everything that doesn't meet these criteria. Common examples of separately recognized intangibles: customer relationships, brands, patents. Licenses. Common examples included in goodwill: workforce, market position, synergies, general reputation. Presentation and disclosure. Question 7. A company uses the revaluation model for its property, plant, and equipment under IFRS. During the year, it revalued a building, increasing its carrying amount by $2 million. This increase was recorded as a revaluation surplus in equity. All else equal, the immediate effect of this revaluation is A. An increase in total assets and a decrease in the debt-to-assets ratio. B. An increase in comprehensive income and an increase in the return on equity. C. An increase in depreciation expense and a decrease in net income. Correct answer, A. The revaluation increases the carrying amount of the building by $2 million. Since the building is an asset, total assets increase by the same amount. Example, if total assets were $100 million before, they become $102 million after. Debt to assets ratio equals total debt divided by total assets. The revaluation does not affect total debt. Liabilities remain unchanged. With total assets increasing and debt staying the same, the ratio decreases. Example, if debt was $50 million and assets were $100 million, ratio equals 50%. After revaluation, assets become $102 million, ratio equals 49%. B. Incorrect. Revaluation surplus is recorded in other comprehensive income, OCI, which is part of comprehensive income. However, comprehensive income includes both net income and OC. A revaluation surplus does not increase net income. Return on equity equals net income divided by average shareholders' equity. Revaluation increases equity via the revaluation surplus, but does not affect net income. Example, if net income was $10 million and equity was $100 million, ROE equals 10%. After revaluation, equity becomes $102 million, ROE equals 9.8%. C. Incorrect. Depreciation is calculated based on the carrying amount of the asset over its useful life. The revaluation increases the carrying amount, which will lead to higher depreciation expense in future periods. Depreciation is not recalculated at the moment of revaluation. The revaluation surplus is recorded in equity OCI, not in the income statement. Therefore, net income is not affected at the time of revaluation. Future net income may be affected due to higher depreciation, but this is not the immediate effect. The revaluation model under IFRS allows assets to be carried at fair value, with gains recorded in equity, OCI, not in net income. The immediate effect is on the balance sheet, assets, and equity, not the income statement. Ratios like debt to assets are affected by changes in total assets, not debt. ROE is affected by changes in equity, but only if net income is also affected, which it is not in this case. Depreciation and net income are future effects, not immediate ones. Question 6. An analyst is reviewing the footnotes to the financial statements of a company that reports under IFRS. According to IFRS, which of the following is the company not explicitly required to disclose for its property, plant, and equipment? A. The depreciation methods used. B. The gross carrying amount in accumulated depreciation. C. The fair value of the assets. Correct answer, C. IFRS IAS 16 does not mandate fair value disclosure for all PPE. Under the cost model, fair value disclosure is not required. Under the revaluation model, fair value is disclosed as the carrying amount, but no separate fair value disclosure is needed beyond that. Fair value is only required in specific cases, for example, impairment testing or revaluation model details. Example: a company using the cost model for its vehicles does not need to disclose their fair value in the footnotes. In IFRS disclosure requirements for PPE, fair value disclosure is not universally required, unlike depreciation methods and gross or accumulated amounts. A. Incorrect. IFRS explicitly requires disclosure of depreciation methods. Users need this information to assess how the company allocates asset costs over time. Common methods include straight line, declining balance, or units of production. Example: a company must state in the footnotes that it uses the straight line method for its buildings. B. Incorrect. IFRS mandates disclosure of these amounts for transparency. Gross carrying amount shows the original cost of the asset. Accumulated depreciation shows how much of the cost has been allocated to expense over time. Together, they help users understand the net book value of PPE. Example: a company must disclose that its machinery has a gross carrying amount of $500,000 and accumulated depreciation of $200,000, resulting in a net book value of $300,000. Question 5. A company prepares its financial statements in accordance with U.S. GAAP. For its long-lived tangible assets, the company must disclose all of the following except: A. The depreciation expense for the period. B. The balance of major classes of depreciable assets. C. The method used to determine the fair value of the assets for impairment testing. Correct answer, C. Under U.S. GAAP, disclosure of the method used to determine fair value for impairment testing is conditional, not universal. If an impairment loss is recognized, the company must disclose the methods used to determine fair value. However, if no impairment loss occurs, there is no requirement to disclose the fair value methodology for all long-lived assets. Since the question asks for disclosures required in general, such as unconditionally, option C is the correct exception. Unconditional disclosures, such as depreciation expense, asset balances, are required every reporting period. Conditional disclosures, such as fair value method for impairment, are required only when a specific event, such as impairment loss, occurs. A. Incorrect. Disclosure of depreciation expense for the period is an unconditional requirement under U.S. GAAP. This information is essential for users to assess the impact of depreciation on earnings and financial position. B. Incorrect. Disclosure of the balances of major classes of depreciable assets, such as Buildings, machinery is also an unconditional requirement. This provides transparency about the composition and value of the company's long-lived tangible assets. Question 4. When comparing the disclosure requirements for long-lived assets under IFRS and US GAAP, a key difference is that A. Only IFRS requires the disclosure of the depreciation method used. B. Only US GAAP requires the disclosure of estimated future amortization expense. C. Only IFRS requires a reconciliation of the carrying amount of assets. Correct answer, B. US GAAP explicitly requires companies to disclose the estimated aggregate amortization expense for each of the next 5 fiscal years for intangible assets subject to amortization. IFRS IAS 38 has no equivalent requirement. While IFRS requires disclosure of useful lives and amortization methods, it does not mandate a quantitative forecast of future amortization expense. This is a clear difference between the two standards. Intangible assets are a major category of long-lived assets, making this requirement highly relevant. This is a well-established, frequently tested difference in accounting education and certifications. A. Incorrect. Both US GAAP and IFRS require disclosure of the depreciation method used. IFRS requires disclosure of the depreciation methods used. US GAAP requires a general description of the method or methods used in computing depreciation. This is a common requirement, not a differentiating factor between the two standards. C. Incorrect. While IFRS IAS 16 requires a more detailed, formalized reconciliation of the carrying amount of property, plant, and equipment, PPE, US GAAP also requires information that allows users to track changes. US GAAP requires disclosure of the balances of major classes of depreciable assets at the beginning and end of the period, the amount of accumulated depreciation both beginning and ending. To present these balances, a company must inherently reconcile the change, even if not in the same structured format as IFRS. The difference is more about presentation format and level of detail, rather than a complete absence of reconciliation requirements in US GAAP. Therefore, this is not as fundamental a difference as the 5-year amortization forecast requirement in US GAAP. The 5-year amortization forecast under US GAAP is a unique requirement with no IFRS equivalent, making it a clear key difference. While IFRS may require more detailed reconciliations, US GAAP often requires similar information in a different format, which may seem like a difference but isn't as fundamental. If both standards require the same information, like depreciation method disclosure, it's not a differentiating factor. Long-lived assets include both tangible and intangible assets, so requirements related to intangibles are highly relevant. The most definitive key difference is the one that is explicitly required in one standard and entirely absent in the other. Using disclosures and analysis. Question 3. An analyst is reviewing a company's fixed asset disclosures. The analyst gathers the following data in millions. Historical cost of PPE, $75,000. Accumulated depreciation, $30,000. Annual depreciation expense, $2,500. The analyst states, I will estimate the average age by dividing accumulated depreciation by depreciation expense, and the remaining life by dividing net PPE by depreciation expense. The total useful life is the sum of these two estimates. Based on the data provided, the analyst's estimated total useful life is closest to A. 18 years, B. 30 years, C. 48 years. Correct answer, B. Average age of the PPE equals accumulated depreciation divided by the annual depreciation expense. In this case, 30,000 divided by 2,500 gives 12 years. Remaining useful life equals net PPE, which is historical cost minus accumulated depreciation, divided by the annual depreciation expense. Remaining useful life equals 45,000 equals 75,000 minus 30,000 divided by 2,500 equals 18 years. Total useful life equals average age plus the remaining useful life. Total useful life equals 12 plus 18 equals 30 years. This approach is logical as it combines the time the assets have already been in use with the estimated remaining time they can be used. Two crucial questions. Question 2. A manufacturing company is evaluating two approaches to obtain a customer database. Option 1 involves purchasing an existing customer database from a competitor for $1,200,000. Option 2 involves spending $1,200,000 on marketing and sales efforts to build a similar customer database internally. If the company chooses option 1 external purchase instead of option 2 internal development, the financial statements in the year of acquisition will most likely show higher operating expenses on the income statement. B. Higher net income. C. Lower return on assets. Correct answer, B. Under option 1 external purchase, the $1,200,000 cost is capitalized as an intangible asset in, amortized over its useful life. This means only a portion of the cost, amortization expense, is recognized on the income statement in the year of acquisition. Under option 2, internal development, the $1,200,000 is expensed immediately as marketing and sales costs, reducing net income in the year of expenditure. Therefore, option 1 results in higher net income because the cost is not fully expensed upfront. A. Incorrect. Option 1 leads to lower operating expenses in the year of acquisition because the cost is capitalized, not expensed. The amortization expense, if any, is much smaller than the full cost. Option 2 results in higher operating expenses because the entire $1,200,000 is expensed immediately as marketing and sales costs. B. Incorrect. Return on assets is calculated as net income divided by total assets. Under option 1, net income is higher due to lower expenses and total assets are higher due to capitalization of the intangible asset. Under option 2, net income is lower due to full expensing, and total assets are unchanged, no capitalization. While our OA depends on the relative magnitudes of these changes, the question focuses on the year of acquisition, where higher net income is more directly observable. ROA is not necessarily lower under option 1, and in many cases it may be higher due to the proportional impact of higher net income. The timing of expense recognition is critical. External purchases capitalize costs, leading to lower immediate expenses, while internal development expenses costs immediately. Operating expenses are lower under external purchase in the year of acquisition. Return on assets is influenced by both net income and total assets, but the question emphasizes the year of acquisition, where higher net income is the most direct and observable impact. Question 1. Under U.S. GAAP, which of the following is a required disclosure for finite-lived intangible assets? The estimated amortization expense for each of the next 10 fiscal years. B. A reconciliation of the carrying amount for each major class of intangible asset. See the gross carrying amount in accumulated amortization by major class of asset. Correct answer, C. U.S. GAAP explicitly requires disclosure of gross carrying amount, original cost, and accumulated amortization. Information must be presented both in total and broken down by major intangible asset classes, such as patents, customer relationships, technology. This disclosure helps users understand the magnitude of investment in different types of intangible assets, how much amortization has been recognized for each asset class, the remaining net book value of each asset class. A. Incorrect. U.S. GAAP only requires disclosure of estimated amortization expense for the next 5 fiscal years. The requirement for 10 years is excessive and not consistent with FASB standards. Estimates become less reliable over extended periods. The 5-year horizon provides sufficient information for decision-making. FASB aims to balance disclosure, usefulness with reporting burden. B. Incorrect. The reconciliation approach is more common for property, plant, and equipment under U.S. GAAP, long-lived assets, tangible and intangible under IFRS, U.S. GAAP focuses more on current carrying amounts and amortization status, future amortization estimates for 5 years, rather than detailed movement analysis. U.S. GAAP requires gross carrying amount in accumulated amortization by class, requires 5-year amortization estimate, doesn't require detailed reconciliation of carrying amount movements. IFRS requires reconciliation of carrying amount showing all movements, has different impairment testing approaches, more principles-based in presentation requirements.